Hey everyone, and welcome back to another video for today. So I guess it's now time to circle back to cover Grab. So Grab is yet again under $5, actually at $4.57 after hours on Friday. This is still a company worth around $18 to $19 billion. Over the past 12 months, the stock has beaten the market. It's still up closer to 30%. Now, valuation-wise, of course, if you look at trailing PE or even forward PE, you might say, okay, this makes absolutely no sense. Why would I buy something like this? But remember, when a company starts to become profitable, those metrics usually are quite high. It's very important to note how fast they can actually expand margins, how fast they can become more and more profitable in the upcoming quarters and upcoming years. Margin-wise, we have gross profit margins of just over 40% over the past 12 months. So those things are also improving. When you look at net income margin, for example, 0.8%, free cash flow margin closer to 29%. Currently, the average analyst price target does sit at $5.80. Of course, it was closer to that price target a couple of months or maybe a couple of weeks or so ago. And so let's revisit the case for Grab, because I do know that a while ago this became a very, very popular stock suddenly, and everybody was expecting this to double, triple, or quadruple in a record time. But remember, just because a stock is worth $5 per share, $4 per share, does not mean it should be worth $50. No, behind that stock is a real company, behind that price is a real company. Plus here at $4.5, it is already $19 billion worth of a company. So don't always think that a low price per share equals a low market cap. No, not at all. Also, as we noted a month or so ago, Howard Marks from Oaktree Capital Management, they have 53 positions in their portfolio, a portfolio worth over $4 billion. They did actually open up a position in a Grab last quarter, not the quarter that we're in, but the quarter before that. So Grab is worth 1.15% of the portfolio, a position worth around $46.5 million. And so before continuing, if you enjoy this type of videos, hit all the buttons, especially the subscribe one. We really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so first up, a couple of things that have happened in June. So one, Grab priced optimized $1.5 billion convertible notes offering. Now, the important part here is the following. Why would they need this amount of cash? Especially since they already have a good cash position. Well, now they're just increasing that cash position, and they said the following thing. Grab intends to use the net proceeds from the notes offering for general corporate purposes to optimize strategic flexibility, which may include potential acquisitions such as the GoTo rumor, while continuing to maintain a high bar for such transactions. For the concurrent repurchase, as described, in relation to which it expects to fully utilize the $274 million authorized but unused amount under its $500 million share repurchase program announced in February 2024, and for any other share repurchases that may be authorized by its board of directors. So of course, now that they've increased the cash position, look, we actually think our business is undervalued, so we are accelerating our buybacks. Could also be an option. Now, another thing here, and this is something that we've seen with Nebius as well. The initial conversion rate of the notes was at a price approximately $6.55 per Class A ordinary shares and represents a conversion premium of approximately 40% above the closing price of $4.68 when this was announced. So it's even higher right now. Now, of course, the difference between this and a Nebius, for example, is that one, Nebius, of course, has a lot of momentum, especially because of CoreWeave as well, and more specifically because of the AI segment. So Nebius did go up after this announcement. Grab actually went down. Now, I don't know if you remember, but the last time I covered Grab, I focused a lot on the geography, right? The placement of that company, Southeast Asia. Why is that? Well, because if we look at the GDP growth for most of the countries that Grab operates in, right? Indonesia, Philippines, Singapore, Thailand, Vietnam, you can see that GDP growth here has been growing much, much faster than a lot of other places on this planet. Now, of course, this is what has happened before, but what exactly is expected to happen in the future? Well, as you can see right here, again, Grab operates in countries where GDP growth is expected to grow quickly over the next coming years, much faster than more established markets. And of course, if you're a leader in your industry, then you will benefit from this quite a lot. And this is one of the main things that makes Grab quite attractive. If you want, of course, exposure to Southeast Asia, if you want exposure to a business that I'd say is a kind of super app. And so if we look at what the analysts are expecting this company to do in the coming fiscal years, revenue-wise expected to grow 20% CAGR or so in the next coming fiscal years, while free cash flow is expected to come down in fiscal 25, but it's expected to grow 29.6% in fiscal 26 and then another 44% in fiscal 27 to over $1 billion in free cash flow by fiscal 2027. Now, if we look at the trajectory, if we look at total monthly transacting users, it has grown quite nicely, 15.6%, although if you look at the report, they'll round it up to 16%, but the number here specifically is 15.6%. Yes, it has been coming down a little bit quarter after quarter, but this is also a year-over-year increase on top of the 15.6% we've seen a year ago, so still very good. If we look at the different segments of the business, of course, they do deliveries, mobility, and financial services. If we look at, well, since the March quarter of 2023, deliveries have grown to a compound annual growth rate of 18.8%, mobility just over 20%, and financial services, of course, much faster than that, but that's the orange bars right here, much, much smaller, so at 44.3% CAGR. But that is expected to become bigger and bigger, and as we've seen with other players that try to do the exact same thing, having a financial arm is of course very, very lucrative for you. If we look at the adjusted EBITDA part of it, of course, deliveries and mobility are adjusted EBITDA positive, financial services still in the red. Now on that financial services part, we can actually go back to Fiscal AI, look at the transcript and actually ask it a specific question about the financial services segment, the profitability part of it as well. So they said the following: the financial services business has benefited from cross-selling within the Grab platform, with the majority of new financial services customers originating from Grab's existing user base. Again, when you have a super app, this is a huge, huge benefit that you have, right? If you launch new products, well, the existing user base will suddenly get exposure to those new products, and you don't really need to market or increase your marketing spend in order for the existing users to adopt the new products. Of course, if you want to attract new ones, then you'll have to spend more. But that said, I do want to touch on the incentives part of it in just a bit. So loan book growth and credit quality. The loan book growth grew, but the company is also increasing credit provisions as the loan book scales. Non-performing loans, or NPLs, are currently stable quarter on quarter, and the company is monitoring credit quality indicators. They are taking a prudent approach to loan disbursals. Revenue growth reacceleration. The company anticipates revenue growth reacceleration in the second half of the year, driven by increased lending to consumers and continued growth in lending to partners. Q1 was the first quarter in which they had loan products from all three banks in the marketplace. As they grow the volume of loans, they are running expected credit losses through the P&L in order to strengthen the balance sheet. They are attracting target markets for these loans in Singapore, and I do think that they said that 2 out of the 3 banks are already profitable for them. And so for this segment right here, it's not a question of if it becomes profitable, it's just a question of when. Now, moving on to the partner and consumer incentives, you can see that this has grown 20.4% year over year last quarter, and the quarter before that, it grew at 29% year over year, but that's because, well, the year prior, that actually decreased 3.6%. Now, what exactly are those incentives? Well, partner incentives are payments or bonuses given to driver merchants to boost engagement, supply, and activity on the platform. For certain delivery offerings where Grab is contractually responsible for the delivery service, these incentives are recognized in the COGS, cost of revenue, rather than as an operating expense. That's the big difference here. Now, as for the consumer incentives, those are discounts and promotions for users. They are treated similarly, reducing reported revenue rather than being booked as sales and marketing expense. Now, what's interesting here is that if we look at, well, the incentives as a percent of a GMV, so you look at deliveries, mobility, and then total on demand. Q1 2025, partner incentives 4.4%, consumer incentives 5.7%. Now, yeah, there was a slight increase year over year by 0.2% for both of those, but that's not such a big deal. They've also told us during the last earnings call that they're really focused on making sure that, well, they don't have to spend that much anymore with regards to incentives in order to grow the existing user base. They've been doing that to make sure that, well, the existing user base does see value, that there is enough supply when there is quite a lot of demand. It makes sense, right? Because when you have such a platform, when you have, let's say, a super app, you really want to make sure that that super app is the best out there. So yes, sometimes you have to spend to stay the best and offer the best services. But as this scales up, I do think that they will have, well, less of a need to increase it by that much, because the app will just become so good and so important to those people's daily lives that they'll anyways use it no matter what. They've also talked about using AI to make sure that, well, for example, for marketing purposes, things can run smoothly. Advertising side of the business is, of course, expected to grow as well. And then this leads me to think that, okay, maybe if they are going to acquire a e-commerce type of company, well, that could definitely help the advertising side of the business, plus the retail side as well. So truly creating a super app. Now, of course, with the acquisition or non-acquisition of Goto, we'll see what happens with that in the future. Lastly here, if we look at the stock, we look at the daily candle, you can see that the stock did end the week right on top of that 200-day moving average. If we look at the weekly one, of course, it's still on top of the 200-day moving average, but this is what you can see. Previously, we did drop under the 200-day moving average, but that was at the start of April when everything went down, but it didn't take a long time until we saw this rebound and went back over it. Now, let's see if we can rebound on top of that 200-day moving average. If we can, that should be quite a positive sign. We've seen it time and time again when a stock does rebound or does land on top of that 200-day moving average and then experience a nice rebound. Usually the rebound is quite aggressive. And so to conclude, to me it's pretty simple. The opportunity is definitely there. Now, this is again a company worth close to $20 billion. Just because it is only $5 per share or close to it doesn't mean that it's expected to 5x or 10x just like that. Is it opportunity cost, right? The fact that the stock is down year to date? No. Opportunity cost, this is just a lazy excuse. I've seen it time and time again. Oh, it's opportunity cost. No. When you buy it and you have a thesis and you have a long-term thesis and a target, then it's not opportunity cost because for 6 months or a year the stock has underperformed. No, you can tell me maybe opportunity cost in the future. Also, when you say you buy a stock, you want to hold it for the long term, and then you see another stock outperform it, you cannot say opportunity cost here either, because that just doesn't make any sense, right? In hindsight, oh, I should have bought this. Yeah, of course, in hindsight, I should have put the correct numbers to win the lottery, but I didn't. But here, if let's say 2 years from now, 3 years from now, 5 years from now, it is $100 billion company, maybe even more, who knows? Are you still going to say, oh, but in 2025, opportunity cost because I could have bought this stock, which went up 50% and sold it 2 months later and then come back to grab? No, okay, this is crystal ball talking. This is not how investing works. So yes, Grab, I still think, is a very interesting and very good business, which operates in fast-growing markets. But it does seem like, yes, the stock needs more time for the market to realize that, okay, maybe the company is actually doing something interesting here. And that's about it, right? For those that did buy this and thought that this would be at $10 tomorrow, sorry to disappoint, but was not going to happen. So anyways, that's about it for me in this video. If you enjoy this type of videos, hit all the buttons, would really appreciate that. And I'll see you all in the next one. Bye bye.